So unless you've been hiding under a rock for the last couple of weeks, you will have noted that China has been the best performing market in the whole world over the last couple of weeks. And there are many people that say that there's a lot more to go with China. China has a lot more rally to come. They've got a lot more upside because they're really cheap. And we have a lot of catalysts behind us. But there's other people that say that China could suffer the same fate as Japan in the lost decade of the 90s. And so which one is it? We're going to go through this in this video. And if you like these videos, please feel free to put your thumbs up, subscribe to the channel, and please stay to the end because we'll be covering what we like here and what we want to be buying. So we'll get right into it. So this here is David Tepper, and David Tepper's been saying that he's been buying China with both hands. And he says that he's thrown out all his risk measures and increased the percentage he's putting into China because China is so cheap. And even though it's rallied, that he's still buying. And of course, Goldman Sachs is also saying that there's more rally to come. Usually I don't really buy into much of what Goldman Sachs has to say because a lot of times when they say to buy, they're actually selling. But it may be that Goldman Sachs has already bought and they feel that China is still cheap. And it looks like China is still pretty inexpensive here. So we also see that Michael Burry, based upon his 13F filings at the end of the second quarter and the third quarter, he had more than 50% of Cyan Capital's assets in Chinese stocks, primarily Alibaba and JD, and he has a few more, but over 50%. And he may already be out now, or he may still own a lot of China, but it still looks like China is cheap here. So most of these people feel that China's stocks are a lot less expensive than comparable companies in the U.S. And of course, around the world, comparable companies to the U.S. are also a little bit cheaper, but China looks to be the cheapest, especially in the technology market. The Fed lowered rates on September 18th, and when they lowered rates, it allowed the Chinese to start to stimulate as well, because what the Chinese wanted to wait for is for the U.S. to start lowering rates and for our currency to not be quite as strong. And when the U.S. is lowering rates and undergoing a little bit of stimulus, then that can cause the dollar to weaken a little bit. So they did not want the Chinese yuan to get too weak versus the dollar. So they waited for the U.S. to start to stimulate and lower rates before they started to stimulate and lower rates. And they brought out a bazooka. China's really brought it out. They've done a lot of measures to try to stimulate their economy. I think that their central bank is actually buying stocks now. So they're buying stocks, they're buying bonds, they're doing everything to try to get these banks to loan money, but the banks aren't wanting to loan money because they've had a property crisis in China. So the banks aren't loaning money out because they're afraid. A lot of these banks have been going under because of the rampant speculation in the property market, and the bubble has burst in China. And the consumers are afraid because they don't want to lose any more money. The consumers in China, the investors primarily have invested in the property market. The Chinese people don't invest in the stock market as much as they invest in the property market. So they'll buy their first homes or apartments, then they'll buy a second apartment, then they'll buy a third apartment, and they never put any furniture in there. And so we've got cities and cities full of empty apartments in China, these ghost cities, because these Chinese are investing, and more people have come along and invested behind them. It's sent the property values way up, but there's nobody living there. There's no use for these properties. It's just speculation in the properties. And so the government is trying to get these people to borrow more and try to get the banks to lend more, but no one's biting. There's not a lot of confidence in the government or in the property sector because the bubble's already burst. And the other thing that China has against it is they've got an aging demographic, and so they've got less people to work and less people that are starting out. And so it's usually those younger people that are spending to get the economy going, and they just don't have that. And so there's not a lot of confidence in the Chinese market here, but It may be that they get things moving. It may be that they find some fiscal stimulus like the U.S. did coming out of 2020. Fiscal stimulus, when monetary stimulus doesn't work, fiscal stimulus can work. And so they might start throwing more money at the problem, and that could get things going potentially. We shall see. It could be more like 2008, 2009 in the U.S. where China recovers like that, or it could be more like Japan. And we'll show you a little bit about how things went in Japan and why they went the way they did in Japan. But when we look at these charts, we can see that China has recovered faster than any other time period in the last couple decades. And we can also see this green part here. Everybody thought China was going to recover coming out of 2022. And we did see a recovery. They called that the reopening, but they also had draconian measures to try to combat COVID there. And that caused lots of things to not really happen for them. And people were afraid to do anything. And so the markets sold off after that. Will they sell off again here? We don't know. Let's take a look at some of the charts. So when we look at, this is the China Large Cap Index. And you can see this is COVID, that's the pandemic, that's a sell-off in the pandemic. And then when they put in this big high in 2021, but we had this big sell-off here. So China went through this bad period where they had these draconian measures to fight off COVID, and the market bottomed in 2022. And then they reopened. We all thought China would be coming back with a vengeance. So they reopened in early 2023, and then they sold off again. We got a lower low at the beginning of 2024. And so the large cap stocks in China, they went even lower than they did in 2022. But since then, over the last couple weeks, you can see, oh, it's really spiked. It's gone even higher than it did in 2023. And that's a sign that we're past the worst. If we take a look at the technology stocks, these are the technology stocks in China. And with the technology companies, a lot of these darlings like Jack Ma got a little too big for his britches as far as the Communist Party was concerned. And Jack Ma disappeared for a while. And some of these other technology companies had leaders that the Communist Party felt got a little bit too big for their britches. And so they suffered from the tall poppy syndrome, where the Communist Party wanted to cut them down. And so the technology companies, they put draconian measures in place for these technology companies, and they sold off precipitously here. You can see how in 2021 we had they were booming, and then going to 2022 we put in this low at the end of 2022. And it may be that the technology companies come back with a vengeance. It may be that there are some new technology companies that come about in China that really take over. And the one thing that we are concerned about, though, is that some of the people that may be wanting to start technology companies or lead these technology companies may be too afraid of the Communist Party to do anything, to take enough risk to really stand out and make a difference. So we'll see what happens there. But the technology companies are beaten up incredibly. At the end of 2022, they were really inexpensive. And we had this reopening, and they rallied, and then they sold off. They put in a bottom here, but that wasn't as low as the bottom in 2022. So we've also seen the same rally out of the technology companies that we did out of the large caps in general. But you can see the difference here between where it is now and the high in 2021. We've got a long way to go. It can more than double here before it gets back to where it was at the beginning of 2021. And the technology companies in China, if you compare Alibaba to Amazon, it's so much less expensive. So with these companies, you've got a lot more room to run, especially when you consider the demographics in China and the number of people in China and how inexpensive these companies are compared to the U.S. counterparts. So moving on, we can note that Japan, there's a lot of similarities between Japan and China. So if we look at Japan in the late 1980s, early 1990s, Japan was the second largest economy in the world, second only to the U.S., and they were booming. Many thought that Japan was going to take over the world. Many people thought that with Japan buying up everything in the U.S., we were really concerned about Japan eating our lunch. But What we saw in Japan is we saw speculative frenzy in the stock market. We saw a speculative frenzy in their real estate market, and things did not turn out well in Japan. So the key difference between the U.S. in the mid-2000s, 2008, 2009, the great financial crisis, and Japan, they had an aging demographic. So they had people that were getting a lot older, and they didn't act as quickly as the U.S. did in 2008, 2009 to stimulate and get things back on the right footing. They were acting in a more measured pace. And so we're seeing a lot of the same things happen in China. They're acting in a more measured pace, partly because they're afraid of devaluing their currency. So with the U.S., we don't have to worry about that as much. In other countries, they worry more about devaluing their currency versus the U.S. dollar. So they operate at a more measured pace, but they've also got this aging demographic problem, and people are afraid to spend. People are afraid to spend, the banks are afraid to lend, and they've got this property bubble, much like Japan, where it's been popped. And so we've got all these similarities to Japan. It may be that China is going to be able to look back in Japan and see where Japan messed up, and look at the U.S. and see where the U.S. did okay, and take more page out of the U.S. during the great financial crisis and coming out of COVID, where there was a lot of fiscal spending. China could do more fiscal spending to stimulate the economy, and they could do more to encourage the consumers. But these consumers, they're used to investing in property, and they're a little bit leery of the Communist Party. There's a lot of younger people that are not that crazy about the Communist Party here, and there's a lot of technology company founders that don't want to deal with the tall poppy syndrome. They think it's too risky to try to go out there. For them, why take the risk if they're just going to be cut down by the Communist Party? So we have that going against the Chinese, and so the China really very well could stimulate the rest of the world more than they stimulate themselves. And so that may put the recession in the U.S. further out in the future, or it could keep the recession from heading into as bad a recession as what people may think. But what we're also seeing here in the U.S., especially in conjunction with the election, is we thought, or the Congressional Budget Office was saying that they were going to spend about $1.6 trillion this year, and they upped that to about $2.1 trillion because they approved another $400 billion to spend before the election. And so all this spending helps to stimulate the economy, and the spending may not be that great of an investment, though. It may not be going and being spent in a very efficient manner, because as we could see here on the left, the government has increased the debt by well over $7 trillion since the pandemic, and the growth in the economy has been about $6.5 trillion. And I don't know about you, but if you have an investment where you can spend $7,000 and it returns $6,500, I personally don't like losing money on my investments. And with the government, they don't seem to mind losing money on their investments as long as it keeps the people in power that are choosing to spend the money. So they're spending this money to keep the economy afloat, to keep people happy, and sending money to people that are helping them out. But it may not be the best investment, and we'll see what happens with this. But this is what we've seen so far this, this is so far this year. This is since the pandemic. So Warren Buffett is fond of saying you pay a very high price in the market for a true consensus. And so some people are waiting to invest in China because they're afraid of war. And actually Warren Buffett is one of these people. So he's not investing in China. He's not investing in Taiwan. He's actually sold out of some of the investments he's had there. He owned Taiwan Semiconductor, which he said was the very best semiconductor maker in the whole world, because he was afraid of geopolitical tensions. Buffett also had other investments in China that he sold out of over the last couple of years. And Warren Buffett's right-hand man, Charlie Munger, was a big part of getting him to invest in that. Charlie Munger bought a big chunk of Alibaba a couple of years ago before he passed away. He wasn't as afraid of war and all these things, but Warren Buffett is. So that's something that we may want to consider with geopolitical tensions. But there's a lot of really good, really well-known investors like Charlie Munger that are big on China and like China because it's really inexpensive here. David Tepper's bought a lot in China because it's really inexpensive here. Michael Burry has more than 50% of his portfolio in China because it's really inexpensive here. So you pay a very high price for a tree consensus. So if you're waiting for us to be 100% sure there's not going to be a war, we may have lost our opportunity. So right now, China's had a good leg up. Most likely it'll consolidate. If it consolidates a little bit after the election, we'll have more certainty there, but it may consolidate before the election, we'll see. And after the election, it may be that we're not as concerned about China invading Taiwan. So things that we're looking at with all the stimulus and all the money printing that's happening in China and maybe happening in the US, that'll devalue a lot of currencies. So that's good for gold. So we like gold here. That'll be good for cryptocurrencies and Bitcoin and blockchain type investments. That's good for a lot of the miners here. It may cause a lot of markets to move in the near term, but we're also concerned about an overall slowdown with less consumer spending, less consumer confidence, and these high yields causing more and more slowdown because there's a lag effect there. It doesn't happen all at once, there's a lag effect, and it takes a while for the economy to get back rolling. So recession is still a big thing to be concerned about, and in a recessionary environment, what tends to do the best is going to be longer term treasuries and gold. So those are things you want to own. And if you follow Warren Buffett's lead, he owns a lot of treasuries here right now. Now he owns a lot of short-term treasuries. When the yield curve starts to get back to normal and the short-term treasuries aren't paying near as much, I'm sure that Warren Buffett will extend his maturities and own some longer-term treasuries. And longer-term treasuries tend to do the very best if we head into a nasty recession. So will that happen? We don't know. The last few recessions have ended going down between 7% and 50% plus. The average, I think, is 27%. So we'll see what happens. But as always, we want to be a little cautious when we're heading into what may be a recessionary environment. So if you like these videos, please feel free to put your thumbs up, subscribe to the channel, and as always, stay thirsty for knowledge. And that's all we have for today.